In this, the 31st lesson in the course, A Critical History of Economic Theory and Policy, we explore the economic program ushered in by President George H.W. Bush, referred to as 1,000 Points of Light. Old-line conservatives were hard-pressed to find much comfort with the spending practices of the U.S. government under Ronald Reagan. Balancing the federal budget was to them a fundamental value and commitment to principle. After 8 years of the Reagan presidency, the question would be whether George H.W. Bush would return the nation to a conservative economic agenda or continue to borrow in order to fund the new Republican doctrine. George H.W. Bush took office in January of 1989. His message to the people of the United States emphasized what he believed to be the role of citizens. I have spoken of 1,000 points of light, of all the community organizations that are spread like stars throughout the nation doing good. We will work hand in hand, encouraging, sometimes leading, sometimes being led, rewarding. The old ideas are new again because they are not old. They are timeless. Duty, sacrifice, commitment, and a patriotism that finds its expression in taking part and pitching in. To be sure, a critical strength of the United States is the nation's extensive network of community-based nonprofit organizations and foundations that fund all manner of civic goods and services, and the millions of people who volunteer their time, expertise, and personal finances to make their community, their country, and the world a better place. Unfortunately, at the same time, there is a pervasive parallel experience of parasitic and criminal behavior exhibited by far too many people. The new president's son, Neil Bush, was intimately involved in a major savings and loan failure. While a director of Silverado Savings and Loan, he voted to approve $100 million in loans to two of his business partners, who defaulted. Silverado became insolvent and collapsed in 1988, costing taxpayers $1.3 billion. What happened to Neil Bush? A top federal regulator testified to Congress that Washington officials postponed Silverado's shutdown from October to December 1988 until George Bush's presidential campaign was successfully culminated. The director of the Office of Thrift Supervision asked the Treasury Department to investigate whether political considerations caused the delay, but no such probe was conducted. Neil got off paying only $50,000 in a settlement of the $200 million federal suit against him and other Silverado directors. He didn't have to worry about his $250,000 legal bill, as Thomas Ashley, a friend of George Bush Sr., and the head of a banking association that was lobbying the federal government for bank deregulation, formed a legal defense fund to pay the bills. Brothers Jeb and George W. Bush had their own histories of involvement in financial manipulation schemes. After assisting an HMO in obtaining a waiver of the standard limit on Medicare business, Jeb Bush received a $75,000 payment, but explained this payment was in return for advice regarding real estate. A $4.6 million loan made by Broward Federal Savings and Loan to a Florida real estate developer was reloaned to Jeb Bush and a partner, Armando Codina. No payments were made on the loan, and the S&L filed suit. In an unusual settlement with the FDIC, Bush and Codina were obligated to pay just $500,000 of the loan and got to keep the building in the Miami financial district that collateralized the loan, Later, the S&L collapsed, costing the taxpayers $285 million. George H.W. Bush, elected to succeed Ronald Reagan as president, came into office faced with more than the financial intrigues of his sons. He and his advisors came up with what they referred to as the flexible freeze plan to reduce the budget deficit. They forecasted the total elimination of the budget deficit by 1993 by freezing all government spending after adjustment for inflation, except for Social Security and interest payments on the federal debt. Many economists expressed skepticism, believing the Bush plan depended on overly optimistic assumptions that the U.S. economy would grow more than 3% a year through 1993, while inflation would be brought down to about 2%. Robert Hershey, a New York Times analyst, wrote in December 1988 that there was a troubling political roadblock in the way of sound economic policy. Hershey wrote, "With the government's fiscal policy, taxing and spending at a political stalemate, the task of guiding the economy is almost solely in the hands of the Federal Reserve. By raising interest rates, the Fed tends to support the international value of the dollar, which limits inflation. Keeping a lid on inflation is a desirable policy objective in itself, but government had an ulterior motive. Undercalculate inflation, and cost of living adjustments are lowered for Social Security and other benefit programs." In a 2005 article, economics professor Mason Gaffney offered his criticism of how government measures the cost of living. Gaffney wrote, "The standard index to the cost of living is the Consumer Price Index, calculated and published regularly by the Bureau of Labor Statistics. This index is, we will see, a political football. Now, shelter costs are about 40% of consumer budgets, and hence of the true cost of living. To accept an extreme understatement of shelter costs while distracting us with lesser factors and arcane methodology shows bias." The BLS, succumbing to the political pressure, keeps modifying the CPI to show less inflation, even while our daily experiences and shrinking savings tell us there is more. In the financial sector, regulatory accounting permitted the thrifts to sell off portfolios of fixed-rate mortgage loans and amortize the losses as the loans were repaid. This held off bank failures, but only for a time. Beginning in 1989, over 2,400 savings and loan associations and savings banks failed, at a cost to taxpayers of around $560 billion. Now it was the commercial banks who were falling victim to a crashing land market and rising delinquencies by homeowners, builders, and business owners. The mid-1980s had seen speculative construction booms in many parts of the United States, as builders had access to bank loans for both land acquisition and construction of new housing units. An expectation existed that the huge number of young adults provided a ready market for whatever housing could be produced. Commercial construction more than doubled in Massachusetts between 1983 and 1989. Increased 137% in Connecticut and 87% in New Jersey between 1983 and 1989. Severe overbuilding was followed by high vacancy rates and then by sharp declines in new construction activity. Builders had bid up land prices far higher than businesses or consumers could continue to pay, and newly constructed projects remained empty and unsold. A chain of loan defaults spread. One of the first casualties was the Bank of New England, whose assets totaled about $18 billion. A rescue plan brought in the Fleet North Star Financial Group Incorporated as the new owner. The FDIC absorbed losses of around $5 billion. During 1991 and 1992, a number of mutual savings banks also failed. These were institutions the FDIC had assisted earlier by approving mergers. The list of failed institutions included many long-established institutions. The list included American Savings Bank, Crossland Federal Savings Bank, formerly Metropolitan Savings Bank, Dollar Dry Dock Bank, Gold Dome Bank, formerly Buffalo Savings Bank, and Meritor Savings Bank, formerly Philadelphia Savings Fund Society. To rescue the nation's troubled banking sector, the federal government created the Resolution Trust Corporation. The Resolution Trust Corporation marketed the commercial properties of failed savings and loans at prices typically well below 50% of the original stated value. Every dollar the RTC did not get was a dollar added to the taxpayer's bill. The glut of properties meant that private sellers were faced with low market prices for even major properties with strong cash flows. Bank failures were good for business, the legal business that is. As Stephen Wilson wrote in 1992, during 1990, FDIC alone paid nearly $300 million in fees to private law firms for work related to failed thrifts and banks. An equal amount was spent by banks and thrifts which were operating under government conservatorship. FDIC estimated total legal fees of $750 million in 1991. By the end of 1990, real estate construction had fallen to a 7-year low. By 1992, the value of all U.S. commercial real estate fell from its 1989 high of $3.5 trillion to less than $2.5 trillion, a drop of 30%. Office vacancy rates in large cities approached 20%. Unemployment in the construction industry hit 17%. The value of new commercial buildings fell to the 1976 level. Banks and life insurance companies held construction and permanent mortgages on troubled commercial properties totaling $730 billion, plus some $75 billion of property taken by foreclosure. Citicorp reported $6.6 billion in problem commercial real estate loans. To promote competition and efficiency in the banking sector, the Bush administration advocated elimination of restrictions against interstate banking while raising deposit insurance premiums for poorly capitalized banks. Bank profits were declining, and efforts to increase net worth required the banks to reduce lending. Investors were also avoiding the bank stocks. A period of bank acquisitions and mergers began. Recession lingered on throughout 1991 and 1992. Oil prices rose following Iraq's invasion of Kuwait. Interest rates increased as banks tightened credit. Official unemployment hit 7.5% in 1991, with more losses in manufacturing employment. As the George H.W. Bush presidential term was ending in 1992, his challenger, William Jefferson Clinton, put the nation's circumstances into perspective for voters. Clinton stated, "The U.S. fell from 8th to 22nd in wage inequality in the 1980s. According to a recent study, 1% of the people in the 80s got 60% of the country's growth. America is evolving a new social order, more unequal, more divided, more impenetrable to those who seek to get ahead." And although America's rich got richer in the 1980s, the country did not. 10 years ago, America had the highest wages in the world. Now we're 10th and falling. We went from being the world's largest creditor to being the world's largest debtor. The stock market tripled, but wages went down. The question to be answered was whether any of the proposals and ideas coming out of the Clinton team would actually address rather than exacerbate the situation he described. We reached the end of Lesson 31.